What's up, guys? Welcome back to another episode, and advance apologies for the poor audio, but I am on the streets here in Chisinau, Moldova, and I just want to introduce this week's guest on the podcast. Now, this guest comes all the way from Las Vegas in the US, and it's an interesting conversation because he talks about getting into property and then getting into the area of syndication and private equity, where you raise funds and you basically deploy those funds. But rather than just buying raw assets, like a building that you just buy and you kind of do it up or whatever, he has been buying communities of mobile homes. So this is an interesting aspect because there's completely different dynamics involved and cash flows and everything like that, and very interesting. Now, he also goes into the area of self-storage, which is a growing market in some sectors, certainly, or some geographic locations. And I've been interested in the self-storage sector ever since I spoke to a guest about 1 year ago. So, guys, I hope you're going to enjoy this. I think you're going to get a lot of value from Matthew's point of view, his insights. And so, without further ado, my conversation with Mattew Ricciardella. Mattew Ricciardella, welcome to the podcast.
All right, great being here, Gavin. I appreciate it.
Matthew, tell us, what is the weather like in Las Vegas, Nevada at the moment?
It's actually quite nice. It's a little bit overcast, probably 65 degrees. Pretty
Okay,
typical for March.
typical for March. Yeah, yeah.
Yeah.
I'm
How
sure it's a
about you?
little bit better. Well, here in Dublin, Ireland, the weather can be a little bit inclement at this time of the year, but we had a nice clear day. There was no rain, so I count that as a win.
Nice. Beautiful.
So, Matthew, for people who've not heard of you before, and we're going to go into the businesses that you've founded and the money that you've raised and the funds that you've created and stuff. We're going to go into all of that. But how would you describe yourself if you were stepping into an elevator and you had 30 seconds to tell someone what you do? What would that sort of pitch be?
Yeah. Well, kind of put simply, what we do here at Crystal View Capital is we raise private equity. We raise equity capital from retail investors. So think about high net worth individuals, family offices, investors of that subset. And then what we do is we pool that capital together in a blind pool fund, and we go out there and we acquire underperforming mobile home communities, manufactured housing communities, and self-storage facilities throughout the US, and we basically turn them around. So these properties are run very inefficiently. Our team steps in, they solve those inefficiencies. As a result of that, net operating income grows, cash flow grows, and within a 3 to 10 year holding period, typically we exit and make some pretty nice sizable distributions to our partners.
Yeah, I was actually looking at your website, and I was looking at, so far you've raised, or you're in the process of doing your fourth fund, I think. Is that correct?
That's
You've
right.
you, you've raised 300 million, you have 600 million under management, and I saw like your first fund, 47.9% IRR,
Yeah.
fully realized. I mean, some fantastic, phenomenal IRRs there. And so clearly mobile home communities and self-storage facilities are a good, asset class to kind of go after. And so
I
we'll
think they
go into
can
some of
be.
that.
I think they
Yeah,
can
I,
be.
based
Yeah.
on your management skills, I guess, and ability to turn it around.
Yeah, I would say who's buying them and who's running them, and then we'll find out if they're a good investment or not.
Yeah, yeah, yeah. Okay, so like just going, let's turn back the clock before we get stuck into all that sort of stuff. Tell us, what did young Matthew do that kind of brought him into the whole real estate and private equity space? Uh,
Yeah, I mean it wasn't glamorous. I could tell you that. It was very humble beginnings. I come from a family restaurant background, actually, in upstate New York in the Catskill Mountain region. And my father was a restaurateur, had multiple restaurants in a small town where I'm from originally. And, started in business as a young age. At 9 years old, I started washing dishes in the restaurants, and learned the value of a dollar, learned the value of hard work, built my way up, started waiting on tables. I worked in the kitchen, that type of thing. But to answer your question, how did I get started in real estate? Really was not good at school, didn't graduate from a prestigious university or anything of the sort. And I found, what kind of career could I enter into where I could make a lot of money and I don't need a degree? And there it was, real estate. So I
Yeah.
became a real estate salesperson. And the way I created and drummed up business was I went out and I would contact owners. So I would do that via the telephone or via face to face, knock on their door, ask them if they'd be interested in buying or selling real estate. And, built up a pretty good book of business from doing that, and just saw a natural transition from being a realtor to being an investor, because one day I cold called somebody and they said, well, why don't you buy my duplex, which was located in Long Beach, California. And this was back in 2004. I was 21 years old. And I thought, well, how am I ever going to buy? I have no money, no credit, no connections. Well, lo and behold, this was the time, where they were giving out loans like it was candy to a baby. You know what I mean? Anybody
Yeah.
could get a
Yeah.
loan. You had the ninja loans and the stated income loans. So I was approved. I was one of those that was approved for those crazy loans, and never looked back. Was able to buy the property. I think I paid $314,000. A couple of years, sold it for $700,000 after about a year and a half, 2 years of ownership. And then I never looked back. I said, why would I be a realtor when I could go out and make that kind of money as an investor? So started flipping houses, and slowly but surely got into commercial real estate because I was looking for mailbox money, safe, predictable revenue streams. And I found two property types I kind of gravitated to because they produced a lot of free cash flow, and those were mobile home parks and self-storage. So I built my career off of those investments, and that was kind of the evolution behind how I got here.
And what's interesting to me is if you were to say mobile homes and self-storage, a lot of people would kind of throw their nose up at that as thinking it doesn't sound very sophisticated. But isn't that the truth? Is that sometimes it's the stuff that's not very glamorous looking is actually where the greatest returns are.
I would have to agree. We call it here in the States, it's not sexy, right? It's not
Yeah,
a sexy investment. Think about your crown jewel corner properties that you really have to pay up for. So this is stuff that, to your point, Gavin, grimy type of real estate that, for a lot of time wasn't in vogue. But I'll tell you what the sexy part is the cash flow.
yeah.
When you can produce that kind of cash flow and do it consistently, I mean, that's a spectacular investment. And that's why I've built my career around these two property types. And now, when I got started back in this business, it was 2007, 2008 when I got started buying mobile home parks and storages personally.
Yeah.
You'd go to a cocktail party and tell people about what you did, and they just look at you and, well, why in the world would you do that? But now
Yeah.
the institutional capital has really flowed in. So, they've become very much in vogue. And you think about your traditional real estate asset classes, you got retail, industrial, multifamily, and office. Well, nobody wants exposure to office right now, and all that capital is being reallocated into more niche investments that are producing a safe, predictable cash flow stream. So storage and mobile home parks are right at the top of that list. So we're seeing huge capital inflows from institutional capital sources, which has been great from an asset valuation perspective.
Yeah, the yields are getting tighter and
Yeah.
it's just looking like a better investment. And tell me this, in terms of, like, can you just, for people that are trying to imagine, when you talk about a mobile home community, like, well, what's the typical size of one of those? Because here in Ireland, I don't think we have a picture of what you're talking about.
Yeah, so and I'm not that familiar with Ireland, so I can't make the correlation or the connection. But typically, the communities that we buy, where we just own the infrastructure, the tenants own the homes, I would say on average anywhere from 100 to 300 sites is kind of the average of where
Okay.
we purchase and where we own.
And so you, if you were to build one of these from new, you would just put in roads, power connections. I guess is there a mains sewer connection, or is it just people have like the kind of septic tank type thing that they connect up to?
Yeah, the full gambit. So just for clarification purposes, we don't buy or we don't build from scratch. We buy
So you're not a
existing.
developer, right?
Correct. But if you wanted to develop it, to answer your question, you'd have to lay the roads, the infrastructure. So you'd build out the roads, you'd set up individual sites with a concrete pad to put a home on, and then you would have obviously utilities. So you'd have underground sewer and water, which would preferably be city.
Yeah,
And some of our communities, it's private. So you'll have private water system with a well, and then you'll have a private sewer system, which could be, to your point, septic. It could be a sewer treatment plant that's internal. But most of our communities are they're public
city.
services. Yeah, that's right. They're city. So you would have the
Okay.
hookups there. So you'd set the home up. You'd hook up the utilities. You'd have some sort of amenities, a clubhouse, things of that sort, landscaping, and you'd start charging lot rent. And then what you would do is you'd sell those homes off to the residents, and then they would own their own home. And that's the beauty about this business, I'll tell you. Compare what we're doing to multifamily, your traditional multifamily apartment. The landlord is responsible in multifamily for repairs and maintenance. So the sink gets clogged, toilet gets backed up,
You have
they
to go
call
and
the
fix it.
landlord, you got to come out and fix it. So you've got overhead, you've got repair and maintenance costs. In the manufactured housing business, they own their own home. So sink gets clogged up, toilet gets
Their
backed up.
business.
That's their responsibility. You're
And
just
tell us,
maintaining the infrastructure.
so somebody who is coming to your place and they want to place one of their mobile homes on your pad, as you said,
Yes.
does a truck come along and drop this mobile home down, and these guys have paid for that to happen, and they're really just renting a space in your community?
Yeah, that happens, but that's more remote. I'll tell you the way that typically you fill spaces in your communities. Typically, as the community owner, you buy homes and you put them on those vacant spaces. You have a marketing team in place, and then you start marketing those homes for sale. Buyer
Okay.
comes in, you convert that buyer, that lead into a sale, and then you sell the home. Hopefully, you make a margin or some sort of spread off of that, but more importantly, you start collecting lot rent at that point. So
And what are
that's
the
what happens.
Yeah, it's really interesting. We can get into the self-storage stuff a little bit later, but right now I'm just so interested in it 'cause it's quite new. From our point of view here in Ireland, we have a massive housing crisis. We have a shortage of homes, so much so that we probably have 7 year capacity. We're behind in terms of how long it'll take to meet the current shortfall. It would take
Yeah.
about 7 years. And so
Wow.
to me, it sounds like
Sounds like
this
I
would
need to be
be,
investing in Ireland.
yeah. It's, well, except that there are so many headaches for investors because of the local government has tried to kind of prevent investors from coming in because we're seen as part of the problem, trying to profit off of, the difficulty. But that's changing at the moment. But like from my point of view, I look at what you're talking about as a really rapid way in which to deliver hundreds of homes, whereas the traditional method of construction here in Ireland is builders move onto a site and they'll do block work and brickwork, concrete. There's carpenters doing all, and so it takes maybe a year to build a house. Whereas you're talking about something that arrives factory built, arrives on the back of a truck, lifted onto place, and that's it, you're built.
Yeah, that's right. Once you've got the infrastructure there, I mean, you could bring homes, you could order 100 homes in one shot, have them all delivered, and then start selling those homes. And if the demand is there, you're going to be able to sell them.
Yeah, that's the thing. Well, there would certainly be demand. I guess the problem here in this country might be from a planning policy point of view. They might have issues with the type of home or whatever, but that's a bridge we can cross. In terms of the economics of it, like somebody's buying a house, say a traditional house in a city. in that area, what would the difference be between buying a mobile home type home and paying for, like we'll say, that house that you mentioned earlier, like the multifamily?
Yeah, so good question. So just to clarify, like I think you're referring to like a single family residence, like a stick built type home in a
Yeah,
residential neighborhood. Typically we want to be about one third of the
a
cost.
third, right?
About a third of the cost because then it's really justifiable because again they're not these folks aren't going to own real estate, they're just going to own the chattel, they're going to own the home themselves, and then they're going to rent the lot from us, so we own the underlying real estate. So you got to make it compelling enough. If they're on parity to one another, I mean, who's going to go in a mobile home community when they could buy the real estate, and get better
Exactly.
financing terms and build up more equity? But,
Yeah, yeah,
in a lot of these areas, we're maybe one fifth of the cost.
right.
So it's really, really compelling for folks, especially on a fixed income, to come in and buy a mobile home versus a stick built single family residence. And a lot of them, frankly, it's not a choice. They don't have the ability to buy a
Yes.
single family residence. And we're providing them an option to own a piece of the American dream, as we like to call it here. They could own their own home. They could build up equity. They could be proud, to have a place called home of their own.
And in terms of the lot rent, as a percentage of the house that they've paid for, what is approximately, what are you talking about in terms of a percentage terms?
Yeah, I don't know if we really factored it because it's going to depend on their monthly payment. Some of them are going to pay cash, so then all
Okay,
they have to do is pay lot rent. Some of them are going to put a minimum down payment and they're going to finance that home at probably 9-10% interest. And in which case, it's probably half and half, somewhere in that range, what is
got
by
it.
and large what we're seeing. So if you got a $500 lot rent, typically their mortgage payment is in the range of 500 as well. So if you're
Okay,
selling homes that are completely, you're outpricing your lot rent, it's not going to make sense for them to pay four times what the lot rent is on the mortgage. They're probably not going to make it. And then you got to
yeah, yeah.
repossess, that home, or you have to deal with a bank and figure out what you're going to do with that home. It's just not a place you want to be in.
So tell us about the management side of owning a community like that. Like, where are the margins apart from the lot rent? Like, how do you step in and buy up a community and turn that around from being a poorly managed place to being a grade A managed place?
Sure, good question. So, every park's going to be a little different. And what we're looking to do is we're looking to purchase from those that are, we would call it, a more unprofessional operator. I'm not saying they're a poor operator, but they're not going to have the level of systems and procedures and efficiencies that a group like ours would have from, having decades and decades of experience in managing these assets effectively. A lot of them we buy, and not to take anything away from a mom and pop operator, a lot of them are mom and pops. So what you do is, you're looking at this performance. A lot of their rents are way below market. They don't really have a professional marketing team in place, so they don't have the ability to sell homes as quickly as we would. They lack capital, so they don't have the ability to invest the capital into the homes to bring them into the site, so they don't really grow their occupancy. They perhaps don't have the capital to invest back into the community. So, think about your infrastructure and your clubhouse and, how could I make this community look nicer? They're in a stage of their life where maybe they're pulling out all of the cash flow to live off of and they're not investing it back into the community.
Mm.
So there's a number of different ways, or we call them levers, that we could pull to create value. And each deal is going to be a little bit different. And that's where it comes back to at the beginning of our call. I said this could be a great investment if you have the right team running it. We pride ourselves on being one of the best in class operators, and we diagnose that property before we buy it, and we know what levers we could pull, how to pull them, when to pull them, and then we go ahead and execute, and then our investors win.
Sounds like a winning formula. All right, I like it.
Yeah, it's a
It's
win-win all around. And the sellers win, frankly. When we go to a seller, it's not like we're looking to steal this community. We're looking for a win-win deal. Some people are unrealistic. It's just not going to make sense. But we try to structure transactions where everybody walks away and they feel like they got a fair deal, because guess what? You could do subsequent transactions with that same seller. Our
Yeah.
investors are happy. They want to do more transactions and invest more money with us because of the favorable experience that they've had.
And does somebody that is, I mean, selling to you, do they sell to you knowing that you're going to pull all these levers and that you're going to probably double the value of the, do they kind of go in there knowing that and it's just, they just don't have the capital to kind of be able, or the resources to do that?
Sometimes they do and sometimes they don't. Sometimes we straight out tell them what we're going to do, and we say, hey, what do you think? And sometimes they'll say, I don't think that's possible. Other times they'll say, yeah, I think you're going to do great. I just don't have the energy to do it. And
Yeah, yeah.
they're happy with the money that they're getting, and they feel like that's a fair deal. So it's not, some of these things do require energy. I mean, when you're bringing in homes, Gavin, and you have a marketing team and you have buyers coming in and you're trying to convert those leads, that's really a full-time sales program. And a lot of these folks don't have the wherewithal to take on that type of undertaking. So
Yeah.
they see the vision, they see the potential, but they don't have the wherewithal to execute upon it.
Right, right. And so moving to the self-storage side of the business, tell us a little bit about that. Like what kind of assets do you buy? What have you got sort of in your portfolio?
Yeah, so to be honest with you, we have right now about 26,000 self-storage units. So those are individual units spread out amongst about 70 different facilities throughout the US. The majority of what we're buying are the mobile home communities. And the reason for that is, just like Ireland, we're in an affordable housing crisis
Yeah.
situation here in the States. A lot of folks are being displaced. So the need for affordable housing has never been greater. On storage, to answer your question, a lot of those markets, not all, but a lot of markets have become oversaturated because it's easier to build storage.
Yeah.
And when that happens, your pricing power gets eroded away. Your ability to increase rents and occupancy gets taken away from you. That's not really happening on the manufactured housing side. Now, luckily for us, most of our storage facilities are in secondary and tertiary markets throughout the U.S., so there's less new supply coming in. A lot of these builders want to be in primary markets, so we're not really experiencing a lot of that. But in some markets, it's really bad as an operator,
Right.
right? Your ability to grow rents and occupancy is completely off the table. So it's a little bit tougher right now than the manufactured housing side is, to be honest with you. But if you buy right and you know how to operate right, you can make a lot of money on the storage business as well. And we've done that for many years.
And so your focus currently is the mobile home sort of stuff. I mean, are you you're raising a fourth fund at the moment, and I see that you're looking to raise, you're targeting 200 million
Yeah,
for a 3 to 400 million portfolio size.
yeah.
How, if you were to guess, how much of that will be mobile home versus self-storage? Would you say 100% or?
No, no. Well, I would say probably more than 75% will be mobile home communities, is what we're
Right, right.
anticipating.
And the earlier funds, something similar or?
So our fund two was 60% mobile home, 40% storage, and actually our fund three is more heavily weighted to storage. It's more
Interesting.
along the lines of 65% self-storage and 35% manufactured housing.
And is that just down to the opportunities that present themselves when you're sitting with cash in the bank?
Yeah, that's a big part of it. That's a very big part of it. So, rewind back to our Fund 3, a lot of these parks, there was just a lot of capital chasing deals. And the way interest rates here in the States, we were at 3-4% interest rates. So deals were just getting completely priced out on the manufactured housing side. But we were seeing compelling opportunities on the storage side. So we really put our emphasis and our focus on that asset class. But now I think those roles have switched. Right now in the U.S., we're seeing rates 6-7% interest rate range.
Yeah.
A lot of buyers are on the sidelines, and for us, I think that's a fantastic time to be aggressive and to go out there and buy when there's limited competition.
The old Warren Buffett saying, buy when everyone is scared and be greedy when everyone is scared. Yeah.
It's fearful. That's right.
Yeah.
Absolutely.
Yeah.
We
It's so
subscribe to
true.
that way of thinking.
Yeah, absolutely. And tell us, Matthew, part of your you have an Osprey Management. You're the founder of Osprey Management. So is
Yeah.
that like I've seen this in my career as well. You create the fund raising sort of private equity side of the house, and then you want to have the management side of the house. You want to have a really strong manager, and a lot of the time, the best way to do that is just to be the manager yourself.
That's right.
And
That's
so
right.
so has that been around since you started Crystal View, or did it come afterwards, or how did you
Yes.
create Osprey?
Yeah, good question. So when we started, we really didn't have a brand. So I think Osprey was always there. We just didn't have the name for it quite yet. And to your point, a lot of operators in our industry, they're not vertically integrated. And what vertical integration means is basically you control the whole process of the investment. So from the purchase to the financing to the marketing to the management, really, and everything in between. So a lot of groups, what they're doing is they're good marketers. They'll raise capital. They'll go out there and they'll buy an asset and they'll go find a third party to manage it and they'll hope and pray that everything works out okay. Well, they seldom do, because what manager is going to care more than an owner about an investment? I mean,
Yeah,
that's just not rational thinking to believe that a manager is going to execute the way that you need this asset to perform by. So what we do is we control that process. Rather than depending on a third party, we like to say we control our own destiny. So like I said, we create a business plan for every investment in our fund and we're managing it and we're controlling that management process from A to Z. And then we put those initiatives in place as we discuss those levers to pull. You know, our management team is very much aware of what those levers are, and they're focused on a daily basis on pulling those levers and delivering, implementing best practices, and that's how we've been able to deliver the cash flow that we have and the returns that we have for our investors.
interesting. And tell us in terms of the lifetime of your investments. I see that Fund One has been fully realized now, but
Yeah.
you say in the Fund Four that the target duration is sort of 10 years.
Yeah.
And do you sell all of the assets at the end of the 10 years, or do you try to create kind of a new fund and maybe some of these assets would end up in the new fund?
You could. There's a number of ways you could exit. In our Fund One, as an example, we sold all the investments off to third parties. So we no longer have any involvement in any investment in Fund One. What you could do is what you're referring to is, I wouldn't use a new fund, but you would recap it. So a
Recap.
recapitalization. So you'd have a larger equity provider come in and take out your limited partners. Now, some of the limited partners that want to stay in, they could have that right or that option. So they could come along for the ride at a new valuation. So that's one way to exit. Another way is a larger REIT, a real estate investment trust, or another private equity real estate fund. They could come and buy the entire portfolio or pieces of the portfolio. So it's just going to depend on that point of time, in time, and what the best exit plan is going to be. For me personally, and for our team, we're all about delivering the best possible returns for our investors. So whatever approach that is, that's the one that we're going to take, that we could deliver the best returns for our limited partners.
And if that was earlier than 10 years, you would
We would
take it
do
if
it.
the offer, yeah, yeah. If the
Right.
offer on the table is worth it. Yeah, exactly.
I mean, it's hard to predict the future, right? So let's say year 6 rolls around and somebody makes us an offer we can't refuse, as an example. We take it, market continues to rally. We look back and go, oh no, how much, look at all the money we left on the table. I mean, that's entirely possible, but that comes
Yeah.
with being an investor, you can't predict the future. You can only make the best decisions based on the facts and circumstances that are in front of you today, right?
It's
And
so true.
you know, our investors are trusting that we're going to make those wise decisions based off the facts and circumstances that we see.
And a lot to do with that will be down to the fact that you have skin in the game. I read there that you personally are investing in the funds. Yourself and your wife have $12 million invested. So, I mean, I think that's a great way to do it because the alignment is there. Your money is in with theirs. And so what's good for you is good for them.
That's right. We like to say we eat our own cooking, right? It's like going into a restaurant and the chef goes and eats down the street. There's a problem,
Yeah, yeah.
you know.
Yeah, there's something wrong. Yeah.
Yeah,
Something wrong with that picture.
exactly. And it's crazy is I see that happening out there, which is nuts to me. But we believe we can't. There's no one that can make a better meal than us, so we eat it too. And I invest on the same terms as my investors. It's not like I'm receiving preferential treatment. The same terms that it's in our private placement memorandum. Those are the terms that I get. And I think it comes back to that. It only enhances that vertical integration, right? So when we're managing those investments, we have a vested interest, and when we're putting our own money in, we have even more of a vested interest
Yeah,
to deliver
absolutely.
here. So it creates a wonderful alignment of interest. And then I'll also tell you, Gavin, I do it for selfish reasons. I don't know where I'm going to get a better risk-adjusted return than Crystal View.
Yeah, no, it's very compelling, and I guess a lot of your investors are repeat investors coming back for a third and a fourth fund and so on.
That's right. That's right. I keep going back to the restaurant analogy here, and forgive me because I grew up in that business. But
Of course.
you take care of your customers, you treat them right, you deliver a great meal. They keep coming back, and they tell all their friends and family about it too. No different here, different business, but it's the same approach.
Yeah, yeah, exactly. Word of mouth goes around. Everyone says, "Hey, I made a great return on this investment, and these guys are great." And come on in.
Absolutely.
Tell us, Matthew. I'm looking at some of the things that you've done, which really took my breath away. Is that 92% of your deals to date are off-market deals?
Yes, sir.
So that's a sort of stunning statistic, and I'd love to know
Yeah.
how do you go about finding
Sure.
off market? Because I have a small coaching group that I talk to, and I tell them if you're buying on the market, you're probably overpaying. The way to do it is off market, but it can be difficult to do that because first of all, identifying. So give us some of your tips and strategies on how you go about doing that.
Sure, I'd be happy to. And not to sound like a broken record, Gavin, but vertical integration once again. So it's an in-house sales team. So we've got 8 full-time professionals that are working under the Osprey banner. And what they're doing is they're picking up the phone, they're sending emails, they're going out and visiting with these owner operators of self-storage and mobile home communities. They're visiting them face to face. They're breaking bread with them, having a meal, listening to their story. How did their grandfather build the community? Listening to all the bumps and bruises that they've experienced over their 30 or 40 years of ownership. And once you build a relationship with somebody, it completely changes the dynamic. And I don't care if you're selling cars or mobile home parks, life insurance, it doesn't matter. When you have a relationship with somebody, that person feels compelled to do business with that person they have a relationship with. And that's what we're doing. We're trying to fill a need and satisfy a demand for an owner, for a legacy owner that we as we like to call it. So a lot of these folks, they've reached a stage where they're looking to exit. They've had it for 30 years. It could be siblings that inherited this park, and now it's time to sell. And they feel comfortable with us because we have the capital, we have the reputation, we have the references. They know we're going to take good care of the community. A big part of this too, Gavin, it's not just who could strike the largest check, because there's a lot of PE shops that are a lot larger than us. But that's where the relationship comes in play. From past experience, they could see we're going to be a good suitor for the investment. So we're going to take care of the residents. We're going to invest back into the community, as we were discussing earlier in the call.
Yeah.
And when they feel comfortable about that, the natural and logical choice is only Crystal View. And our team positions our brand, myself, and that individual salesperson with the best suitor for that investment. And that's how we win on most deals. And that's how most of them are sourced off market. You got to put in the time.
Yeah. It sounds to me like a lot of the lessons you learned as a realtor are paying off because you mentioned that you used to do cold calls and all
Yeah.
this. And a lot of people are put off by the idea of a cold call, but it's fundamental really to your skills at the end of developing the sales skills.
Yeah, here's what I tell my team. We live in a day and age where technology is thriving. It's evolving every day, and some of the things that are possible with technology is amazing. I mean, now I hear they're implanting chips in somebody's brain where basically a mouse and a keystroke will be made based off a thought impulse. I mean, it's really crazy. And
Yeah.
it's amazing, but with that being said, nothing replaces raw human emotion. Two people looking across the table from each other, building a connection. I don't believe that could ever be displaced by AI or technology. And especially with the younger cohort, because of they're uncomfortable with face-to-face interactions, they constantly are relegated to technology. Let me send a text, let me send an email, let me do this or that. How about you pick up the phone? Let's get in
Yeah,
front
yeah.
of the person.
Old school.
Let's old school find out what's going on in their mind and their heart and connect with them. I mean, that I don't believe is ever going to change today as it's going to change 100 or 1,000 years from now. We're all human beings at the end of the day. And if you connect with another human being, you could do some amazing things. And that's all we're doing. It's really simple, but you got to put in the work. You got to be willing to be able to be beaten up a little bit. When you pick up the phone and cold call, not everybody's going to be happy to receive that call.
Yeah.
You got to
Yeah,
have
yeah.
thick skin, get your ego out of the way, because that next connection might be right around the corner, which is a game-changing acquisition.
Yeah, it's so true. It's so true. And so when it comes to raising money then, you've raised at this stage 300 million. When you started Crystal View Capital, like what did that look like in terms of a size of company or organization? Was it just yourself and the first raise was the difficult one?
Oh, very difficult. I mean, the first raise was only $10 million and had to work extremely hard because there was no track record.
Yeah, that's the
You're
tough bit.
basically getting in front of people and saying, hey, I'm going to do this. This is my business plan. Just trust me. I can't really provide you a track record of me doing this in the past. The only track record I had, at least I had personal deals. So I was
Yeah.
buying self-storage and mobile home parks for about 6, 7 years personally before I started Fund One. So at least there was that reference point, but it's still a lot harder because I wasn't managing outside capital. So once I started raising outsized capital and once I delivered for my investors and I had a track record of doing that, it became easier and easier. And now today, we open up the doors. I'm not going to say the capital floods in. We still have to work, but
Of
we
course.
really get to leverage that track record of a decade plus of delivering fantastic returns.
So your first raise was 10 million. When you started Fund Two, you obviously stepped that up. What did that look like, Fund Two?
So Fund Two was a $58 million raise, and Fund Three was a $140 million raise, and
Wow.
now Fund Four is 200.
And do you always meet the target, or do you fall short, or do you over hit it?
Two and three we've exceeded. So we actually had to
Exceeded.
expand on those funds because the demand was so strong, because of our
Wow.
track record and because of the investments and the pipeline that we had of new deals coming in.
It must be nice to feel like you're over subscribed,
It,
essentially.
yeah, it really does. I mean, it's a great feeling to know that you're well received in the marketplace. The word spreads. We have a brand that is synonymous with great returns and integrity. So for me to see the investment community receive us in that light is is very exhilarating, you know.
Yeah, very rewarding indeed.
Very rewarding. Yep.
Um, and tell us, in terms of, I like to talk about the psychology and all of those aspects of it. Like, tell us some of the challenges that you've overcome in your career that you stand out for you, and as being kind of, we talked about Ray Dalio and defining moments and stuff. Like, is there any that really stand out for you in your career?
There's many. I mean, I don't know how much time you have, but this was not an easy path. I could assure you of that, you know. And we had a good conversation before this talk, Gavin. And look, these things are going to happen if you're in business. I don't care who you are. It's not what happens; it's how you deal with it, right?
How you
You
respond,
know,
yeah.
how you respond to adversity, because adversity is going to come. It's just how strong are we as business people and as people. You know, a lot of times this goes deeper than just business. How bad do you really want it? How much passion do you have? Because if you're not passionate about this, one little slip up that occurs, or one little bad thing, or something adversarial that happens in your business, you're just going to pack up and go home. But you see the people that, you know, are solidified in history, these people refused to give up. You know, you look at Rockefeller and these iconic type of names, Carnegie, they probably had, you know, shortfall and you know, bad thing happen,
Failure.
failure upon failure, and they just refuse to give up. And I think that's the common trend. I mean, I remember getting started in business when I was a realtor, and you know, I didn't know where I was going to get my next meal,
Yeah,
let alone next investment. I didn't know, I couldn't pay rent. But you figure out a way, and you're passionate about what it is that I'm doing, and I believe in myself. So I just keep showing up, and you just keep showing up day in and day out. And you have a positive attitude, good things start to happen. And once you build positive momentum, it's like it compounds, right? We
yeah,
in business and investing, the holy grail is compound interest. That's how you could
yeah.
take small sums and make them massive over a period of time. But it's the same thing with having a positive attitude. It's the same thing, you know, with relationships. You start small, but you grow it into something that's amazing. But the only way you do that is momentum, small wins, day in and day out. Never give up.
Yeah, it's absolutely true. And tell me this, Matthew. I mean, you strike me as believing in old school management techniques. Who are talking about a lot of this kind of stuff. Just cold calling and all that. Like nowadays, a lot of the younger generation, as you mentioned, they don't want to, do something in person. They prefer to text and things like that. How much of the new technology do you leverage versus the old school type ways of doing business?
We definitely leverage technology, but we don't let it take the place of that human to human.
Human connection.
I think
Yeah.
the best way that I could provide you an analogy here is the technology allows us to get in front of the person. You know, what we're doing is we've created some proprietary software to find owners' cell phone numbers, to find their social
Okay.
media contacts. Then we're getting in front of them, and once we get in front of them, what we're asking to do is, let's set up a call, let's set up a meeting. Would you like to go out to a cup of coffee? Can we take you out to lunch or dinner? Then we take over from there. So the technology takes us to the person. Then it's on our team to build that relationship, that rapport, and that bond.
Yeah, super important. Those lead building opportunities. And you can do it at scale now because of the technology that's out there.
Absolutely. And we've built up, like I said, some proprietary software where we could track in a database all of the interactions that we've had with these folks, and for some cases 15 years plus. You know, because of how long I've been in this business, you know, I've been talking to some sellers for 15 to 18 years, believe it or not.
Wow. Yeah. Yeah. Longevity.
Yeah.
It's great. And that's the good thing about the business. Um, Matthew, in terms of the advice that you've received over the years, I'm sure some of it stands out as being the best advice that you've possibly received from mentors or whatever it is. Can you give us any of those that come to mind?
Yeah, great question. I mean, I think above all things, you really got to believe in yourself. I know it's cliche, you know, and you hear that all the time and you kind of just shrug it off, but it's so true. I mean, if you don't believe in yourself and what you're doing, you're just, like you said, you have one small failure and you're going to pack up shop and you're going to go home. And the way you're going to have resilience and fortitude in business and life is you really got to believe. You got to believe in yourself, and you got to believe in the plan that you have in place and have passion for it and take care of people. You know,
Yeah.
I think part of life is, one of my mentors said, is pay it forward. And what that means is all the good things that happened to him and all the people that went out of their way to give advice and spend time mentoring and coaching. Now it's incumbent upon us to do that to other folks. And that's why I like to get on podcasts and do these other things, because maybe one thing I say is going to be inspirational for somebody. It's going to change their life, and it's going to have a ripple effect, right? So always look for ways on how you can improve the quality of someone else's life and give something back. Because at the end of the day, yeah, I know we're in it for money, and it's a lot of fun to make money, don't get me wrong, but you don't get to take any of this with you. The only thing we get to
So
take
true.
is memories. And that's all built with other people, you know, interactions with other people, and giving a piece of ourself back is, at the end of the day, what it's all about.
It's a great way to put it, Matthew. I'm conscious of time, Matthew. I just a couple more questions. Like,
Sure.
tell us, is there anything you're working on at the moment that you're really excited about?
I'm always excited. You know, we've got a number of new acquisitions in our pipeline that we're about to close on, so we're really excited about that. We've made some recent structural changes at our corporate office here. So on our management team, we've had some new hires that have been fantastic. We're in the process of making a couple replacements, which we're really excited about. We have some prospects who are about to come in who I think are going to really help take us to the next level and execute this business plan that we've put in place. So we're excited about that. I mean, I'm excited about life in general and where I am at this stage, and some of the, you know, some of the platforms that I'm on to give back is exciting to me. So
Yeah.
there's endless reasons to be excited if you're willing to be open-minded to find them and you have a positive attitude. And I'm sure that could go the other way too.
It can, indeed. Matthew, it's been a real pleasure speaking with you. If people wanted to reach out and learn more about you or connect or whatever, what's the best way to do that?
Invest at crystalviewcapital.com or visit our website at www.crystalviewcapital.com. And whether you want to invest or not, if you think what we're doing is interesting, we'd love to hear from you. But maybe even more importantly than that, any success stories or challenges people are going through, if what we've said today had any kind of impact, I would love to hear about it.
Well, I'll make sure that, yeah, because I do have a small coaching group that I work with. And anytime I speak with somebody on the podcast, there's almost always some great feedback from the guys saying, oh, that guy that was speaking the other day, he said something really. So I'm sure from this discussion today, that's exactly what we'll have again. So, Matthew, thank you so much for your time.
My pleasure. Thank you, Gavin. It was a pleasure being here.
Best of luck with everything. Thanks. All right, guys, I hope you enjoyed that conversation with Matthew. It's been, I'm going to go back to my holiday here. It's lovely and sunny. Sorry about the poor audio for the intro and outro, but I think the actual podcast itself was fine. So, guys, I'll see you next week. Next week is the final episode of season 5. We're going into season 6.